Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Ketio Kunene, I'm the coordinator, and today's topic that we're looking at is policy uncertainty globally and the impact on the economy, including South Africa, hosted by Kevin Lings and assisted by Mr. Errol Meyer. All right, so before I hand over to them to start off on that important topic, I just want to make sure everybody can hear me and understands how this works. This is going to be 45 minutes to an hour. You're going to sit in and listen to the session. And then if you have any questions, there's a questions bar on the panel on the right-hand side. You just type in your question whenever you want to type it in. And then at the end of the session, the gentleman will address the questions for you. And then I just want to make sure that everybody can hear me clearly and that the sound is good on your side. What you can do on your side is first turn up the volume of your speaker so that it can be as clear as possible. And secondly, just to indicate to me that you can all hear me. If you don't mind, on that very same panel on the right-hand side of your screen, there's a small high five. If you can just click that for me, that will show me that you can hear me on your side, and then we can continue. Thank you, Willem. Thank you, Walter. Debocho, yes, thank you, I see you. Thank you, Shirley. Thank you, Roger. Okay, the hands are coming up. Thank you very much. Majority of the hands are up, so sound is good. All right, ladies and gentlemen, let me tell you a bit more about our presenters today so you know who you are listening to when they're talking to you on the other side. First of all, I'm going to tell you about Mr. Errol Meyer, our resident DJ. Errol Meyer is a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estate and Financial Plans, now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He's previously worked as a legal advisor for corporates and as a tax advocate for SARS. He currently holds the position of advisory propositions legal specialist here at Standard Bank. And then his co-pilot today is Mr. Kevin Lings. Since 2001, Kevin has been employed as the chief economist at Stanlib in Johannesburg. Over the past 10 years, the scope of his economic research has broadened to include the G3 economies, as well as members of BRICS. His research is largely used to inform Stanlib's asset management investment process, and he embraces the philosophy that everything should be made as simple as possible, but not simpler. While at Stanlib, Kevin has managed an asset allocation unit trust fund for 5 years, winning the Micropulse Best in Sector Award. Before joining Stanlib, Kevin was employed as an economist with JP Morgan Chase and also worked as an economist within the Nedco Group for 10 years. His initial role within Nedco was an industrial economist. This provided an essential base of knowledge on the South African and regional economy before starting to focus more heavily on analyzing the financial markets. He completed his undergraduate and postgraduate degrees in economics from the University of Witwatersrand, specializing in public sector finance and international trade. Although the missing piece is Kevin's first book on the South African economy, he has published a number of journal articles, both domestically and internationally. Kevin contributes fairly often to the financial press in South Africa, including television, radio, and print media. He also regularly presents at a range of industry-related conferences as well as policy forums. So those are our two gentlemen hosting you for today. I'm going to hand over to them to talk about the economy and the update on the economy today. I'm going to start off by saying hello to Mr. Errol Meyer because he's going to lead us off, and then he'll hand over to Mr. Mr. Kevin Lings.
Thanks, Ketiwe. Well, good afternoon, attendees, and welcome to our third webinar of the year, hosted by Standard Bank Financial Consultancy. Now, I was reading the other day that Warren Buffett is quoted as saying these prophetic words: fear when others are greedy and be greedy when others are fearful. Now, this is sometimes easier said than done. No doubt that South Africans are facing many problems. Just to mention Eskom, what we hear at the hearings on corruption taking place, fees must fall, Moody's, a rating agency that perhaps will decide this week not to cut us any further slack, an extraordinary budget speech where the devastating effect of inflation was used as a tax collection method, etc., and etc., and so I can continue ad nauseum. To add to the confusion for many investors is the direct opposing views in the market, and perhaps articulated very well by two well-known and experienced financial journalists, that has been in the news the past 2 weeks. The one is very optimistic about the future and see value in investing in South Africa now, since we are regarded by world standards as cheap, given the fact that many of these problematic issues are priced into the price already. Add that to Ramaphoria, as opposed to Ramaphobia, a successful election in May 2019, and we may have a winning recipe. The other one is more pessimistic about the future of South Africa and encourage people to move their investments offshore. The last mention is an easy sell because the South African stock market has moved sideways now for almost 5 years and not convincingly beating our enemy inflation over the term, not even to mention the devaluation of the rand. But is the local investment market really a reflection of our economy? I'm not sure, listening to many well-seasoned investment advisors, but I'm out of my depth and therefore would rather resort to specialists in the discipline of economy and investments. Well, if ever there is truth in the saying that most emotions override logic, then now it's a time to stay calm. Emotion must never overrule logic when it comes to investing. And that is precisely why goals-based financial planning is such a useful strategy. Focus on the future. Focus on what it is that you want to achieve in the future, your lifestyle goals. To do so, stick to a well-devised goals-based investment and financial planning strategy, considering investment strategies beating inflation over the term that is correlated to your future lifestyle goals. This is important since our disposable household income has reduced considerably. Now, to sidetrack quickly, failure to adjust the tax brackets for inflation in this year's budget speech, inflation itself, the higher VAT rate, have all played their part to reduce the disposable income of all South Africans, and no doubt that the poor is hit the hardest. I'm afraid that the well-intended Davis Tax Committee recommendations that showed us the unequal distribution of wealth in South Africa is above normal levels have moved to the background now. The sad part is that the latest events only widen the gap between the poor and the wealthy. But to get back on track with the emotions over logic argument, I've already advocated that logic, making use of a goals-based investment and financial planning strategy, is the way to go. But what about the emotional side? Is this perhaps what Warren Buffett meant by saying, be greedy when others are fearful? You be the judge, and I now hand over to Kevin to give us a breakdown where we stand in the economy. Kevin, thank you for joining us today, and over to you.
Thanks, Errol. Only a pleasure. Afternoon, everyone. For South Africa because of the load shedding. In addition, we're going to talk about the Moody's credit rating that we get a review this Friday, and we will discuss whether or not there's likely to be a ratings adjustment for South Africa out of Moody's. And then we'll also talk about what are the growth prospects for South Africa post the election. Obviously, the election is a key focal point, but we need to discuss what South Africa might start to look like after the 8th of May. So there's quite a lot happening in South Africa. Obviously, the news flow right now is fairly negative on the country. The data coming out on South Africa is not especially positive, but I would just be cautious about extrapolating that for the whole of this year, because we do think that the second half of the year will be noticeably better than the first, mainly because the uncertainty surrounding the election will then be out of the way. Before we get into a debate about South Africa, I'm just going to touch base with what's happening internationally. So the first chart is really just a look at a breakdown of the world economy according to the major economic regions. And the point I just want to make quickly is that when we analyze the world economy, we tend to look at it as three economic hubs. The first being China, which tends to cover the Asian region. China is 15% of the world, the second biggest economy in the world. They're still growing at a fairly rapid pace, but obviously the growth rate is not as vibrant as it used to be. Today, the growth rate sits between 6% and 6.5%. And if you go back a number of years, China was growing at over 10%. You'd understand that you can't keep growing at 10% as your economy gets bigger and bigger. Naturally, your growth rate will slow down. But China is still dominant in the Asia region, and obviously being the second biggest economy in the world, have an increasing influence on how the global economy performs. The second part of the world that we focus on is obviously the euro area. That's 15.8% of the world. So a similar size to China if the euro area stays together. Obviously, I'm not including the UK in that euro area, but it tells you that Europe is stronger together than they are if they break apart, and therefore the idea of Brexit is not good from an economic perspective for the UK. I think they're going to struggle having exited the European Union. I think their economic prospects would be better if they could remain within Europe. Europe itself needs to stay together. If there's any breakup of Europe, then individually each country is actually quite small in the global context, and I think would struggle to be as prosperous as they have been. And then the third region is obviously the US, still the world's biggest economy. That's 24% of the world. Their growth rate has started to ease up. I'll talk about that in a sec. But they still dictate global economic sentiment and global financial market sentiment. So what we tend to do when we analyze the rest of the world, we tend to focus on those three regions, the US, Europe, and China. And what you can conclude is that if those regions are doing well, let's say two of the three regions are doing well, then generally the world economy will feel more prosperous. But if all three regions are losing momentum, then obviously the world economy will slow down. Unfortunately, right now, all three regions, major regions in the world, are losing momentum. Europe is close to a recession. It's technically not in recession, but it's very close already. Italy is in recession. Germany is on the cusp of a recession. China, we know, is slowing down. They're still growing at 6%, but that is a moderation in growth relative to where they've been. And the US, as I said previously, also losing momentum. So the global backdrop for South Africa is one of a weakening global environment. That weakening is not that dramatic in the sense that the world economy is heading to a recession. We're certainly not suggesting that at all. We're simply arguing that the world economy this year is not going to be as vibrant as it was last year. And if we look at 2020, we think the slowdown will intensify into 2020. That makes South Africa's task a little bit more challenging because obviously we want to lift our growth rate at the same time that the world economy is slowing. Not impossible to do, just a little bit more challenging, which means we've got to work harder at getting our confidence levels up and getting our growth initiatives in place. So I'm just going to quickly go through some of the charts on those three regions of the world just to highlight the key aspects. As I say, I'm not going to spend a huge amount of time on that. We want to focus on South Africa because there's quite a lot more happening here. But if we start with Europe, you can see the European growth rates have slowed. The GDP number in the final quarter of last year was 0.2%. So still positive, but 0.2 is very close to zero. And as I said, if you break that down by country, you'll see that Germany, France, and Italy are all losing momentum. Italy pretty much in a recession, Germany not far behind. And if you look outside of France, Germany, and Italy, all the other economies are also slowing. And so you're looking at a broad-based weakening in Europe. Now, the reason for this weakening that you've seen in the global economy has a lot to do with President Trump. So what happened was Trump decided that the trade deals the United States has in place with most parts of the world are unfair, particularly the trade deal between the US and China, and to some extent the trade deal between the US and Europe. He regarded those trade deals as being unfair and biased against the United States. Now, when you look at the data, you would conclude that he was right. The trade deals do favor the other countries, particularly China. So there's nothing wrong with the analysis. The problem is that Trump decided to change those trade deals in a very aggressive way and in a way that became disruptive to global trade and to global confidence. And by creating this uncertainty around global trade and trade restrictions, world trade has slowed down. And as soon as world trade slows, global growth slows. So when you look at indicators of trading activity, you'll find that they've all weakened. So have a look at Euro's exports, and you'll see that Euro's exports to the rest of the world are now in negative territory and pretty much heading to a recession. And if you look at most of the major economies, you'll find that their exports are weakening. And obviously, once your exports start to weaken, it feeds back or pushes back on other components of your economy, including your manufacturing sector, and then ultimately your consumer and consumer confidence. And that is what's starting to undermine the euro area. It's really a weakness in trade that has led to a weakness in confidence that is leading to a broad-based slowdown in Europe. Unfortunately, Europe can't do much about the slowdown because normally under these circumstances, most countries would be looking to cut interest rates in order to re-stimulate their economy. In Europe, interest rates are already zero. They've been zero for 3.5 years, and you can't take your interest rates below zero, which means that Europe cannot cut interest rates in order to boost their economy. They could try and stimulate their economy using government expenditure. The problem with that argument is that most governments within Europe are now highly indebted and not able to spend significantly or cut taxes substantially. The result is Europe is slowing with no real policy response. That's not good for Europe, and it's obviously not good for the rest of the world, and I don't think it's about to change. So unfortunately, Europe is in for a phase of very low growth, not necessarily an outright recession, but certainly growth rates that struggle to move much above 1%. If we go across to China, you can see the same sort of effect. By that I mean the exports are under pressure. In the last couple of months, exports in China have turned negative, particularly exports to the United States. And because of this slowdown in exports, China's industrial production is weakening, in particular manufacturing is weakening, and as a result, the broader economy is under pressure. Now, China has got a little bit more room to stimulate their economy, but what we've got to recognize is that over time, China has become systematically much more indebted. So if you look at the chart on China's total debt as a percentage of GDP, it is now around 300%, which is obviously high by global standards. And what that tells you is that every time China stimulates their economy, they're tending to do that by using additional debt, particularly debt within the public sector, in other words, government debt. Now, China has grown incredibly fast. They've created a huge amount of infrastructure over the last couple of decades, but all of that has come at a cost. And that cost is now very high debt levels within government. So it's telling you that while China is slowing down now, their ability to re-stimulate their own economy by the government spending more and more money is now much more limited because there's an acknowledgement that they are too highly indebted, which means China has to find a way to transition their economy, rely less on government debt and government investment to drive their economy, and start to try and encourage more consumer activity. And by that I mean simply people need to go shopping. So if you look at the level of consumer activity in the Chinese economy, it sits at around 40% of their total economic activity. Compare that with the United States, which is up at 70%. That doesn't mean that I think China needs to shop the way the US does. The US shops at an extreme level, but China relies too much on fixed investment spending or on infrastructure development and relies less on consumer or shopping. That is not a sustainable path. While it sounds favorable, what happens in reality is that if you keep investing, you end up building roads and railways and harbors that you don't need. And that's already started to occur in China. And there's lots of examples of roads leading nowhere, of cities being built that are not occupied. And so in order to keep their economy going, China has to rebalance and find a way to get consumers to spend more and moderate their level of investment. It sounds very odd when you're sitting in South Africa, because obviously our problem is exactly the opposite. But for China, they spend too much building stuff. Now, that sounds like an easy problem to solve. The difficulty with it is that China's consumer has a history of high levels of savings and low levels of debt. In other words, you're not talking about a group of consumers that really want to go shopping. They have had an inclination to rather save and not shop. And so you're encouraging people who are intrinsically big savers to stop saving and do a little bit of shopping. I know we could help with that, but it is a difficult problem to overcome. Lastly, if we look at the US, as I said, the US has been doing well. Last year it had very good growth. It beat expectations. But as we look deeper at the data, we find that this year there's indications already that the US economy is starting to soften. Confidence levels have come off. Business confidence, consumer confidence levels have slowed up. The consumer is still in reasonably good shape. But if you look particularly at US manufacturing, you'll find that manufacturing activity has now slowed and is heading towards negative territory. And if you look at US exports, that has also slowed substantially and is pretty much at zero. So the US, while they instigated or were the start of the global trade wars, they are now feeling the pain of their own policy. Because once global trade slows, the US cannot avoid that slowdown. The US is not an island. They are obviously key to the global economy. And as long as the world economy outside of the US is slowing, ultimately the US will be caught up in that weakness. So when we look at the range of indicators on the three major regions of the world, we're left with a conclusion that says, yes, this is a trade war problem, this is a trade and export problem, but it seems to have broadened out into manufacturing and systematically into confidence levels. And the longer that continues on, the more the world economy will slow. So unfortunately, the global backdrop is not as favorable at the moment as it was just a year ago. I need to reiterate, it's not impossible for South Africa to do better under those circumstances. It is simply more challenging. Obviously, it would be beneficial if the world economy was much more prosperous. Our chances of lifting our growth would be so much better. But that's not the case, so we've got to deal with the environment as it unfolds. If we turn our attention to South Africa, there are a couple of points I want to make. They're not new points, but I maybe want to illustrate them a little bit differently. The first is, when you look at South Africa's growth rate, there was a phase, if you go back to 2005, 2006, into 2008, we forget South Africa was able to achieve an average growth rate of around 4% over 10 years. So the chart I'm showing you is a 10-year average of the SA GDP growth for each year that I've got on the chart. And if you go back to 94, the chart says that in 94, South Africa was able to achieve a 10-year average growth rate of only 1%. So when the ANC took over, they inherited an economy that was growing at 1% over an average of 10 years. We were then able to lift that growth rate mainly through fairly good policies. Trevor Manuel was Minister of Finance, sound economic management. We were able to lift that growth rate from 1% in 94 to a peak of 4% in 2008, which means that over a 10-year period, South Africa achieved an average growth rate of 4%. That's phenomenal. Then in 2009, things changed. And what started to change was we changed the leadership of the government, and we started to effectively mismanage the economy. We now know that that spread out into all kinds of dubious behavior, increased corruption, maladministration, waste of spending. We also mismanaged the state-owned enterprises. The net effect of all of that is growth over the last 10 years is now back to that average of roughly 1%. Last year we grew at 0.8%, and this year we're going to struggle to grow at much more than 1% at this stage. So the growth environment is really the limiting factor for South Africa. And if you said to me, what is South Africa's key economic challenge? If you're the president of the country, what do you really have to deal with? You've got to find a way to grow this economy faster than 1%. If we keep growing at 1%, we won't add enough jobs to deal with the population. We need to create roughly 600,000 jobs a year to deal with the growth in the population. We're coming nowhere near 600,000 jobs a year. So in order to create 600,000 jobs, we've got to lift the growth rate closer to that 3 to 4% level rather than the 1% level. So let's debate, how do we grow South Africa? If you're the president, how would you lift the growth rate from 1% and try and move it closer to 4%? Here's your options. The first option is you try and get the government to lift the growth rate. In other words, government plays a bigger part, government spends more money, government gets more involved in this economy. That to me is no longer an option and not a recommended route. The reason is that government debt over the last 10 years has more than doubled. Back in 2009, government debt was 26% of GDP. That was the best it's ever been. South Africa's credit rating from Moody's was an A rating. So in 2009, it would have been legitimate to say government can grow the economy. Government can play a bigger part. That was 2009. Fast forward to 2019, and government debt is now approaching 55% of GDP. The credit rating has been downgraded substantially. Government is a lot more indebted. They simply don't have the financial capacity to spend more money, and certainly not the financial capacity to drive the infrastructure development of this country. If you look at how much money government has actually borrowed, you can see the escalation in the last 10 years. And that escalation in how much new debt government has taken on has occurred without infrastructure development taking place. And that's what's damaged this country. In other words, the government has become a lot more indebted, but has not used that money to develop the infrastructure of the country. Instead, that money has gone much more onto consumption. So things like salaries, social grants, and then a huge amount on corruption and wasted expenditure. The net result is that you've got a highly indebted government and a weak infrastructure. The debt levels I'm showing you from a government perspective exclude the total debt from Eskom, exclude the debt from Transnet and South African Airways, SANRail, the SABC, etc. That is all debt over and on top of what government has already. So when you look at the total public sector debt, it sits at 75% of GDP, and it would be considered high by global standards. Therefore, it's not really a viable option to expect that government is in a position to drive the economy through them spending money. So their involvement has to be more about policy direction rather than them spending money. If you look at SOEs, have they been able to invest in infrastructure, the state-owned enterprises? The answer is no. Over the last 10 years, fixed investment from state-owned enterprises has essentially tracked sideways and is currently in recession. Obviously, the SOEs have become a lot more indebted. But when you look at the balance sheet for Eskom, you look at the balance sheet for Transnet, those entities can't themselves drive this economy. They don't have the financial capacity to lift the growth rate. They obviously remain vital to the performance of this country, but they have to focus on consolidating their financial position rather than trying to expand investment and take on additional debt. At the same time, the country has become more corrupt. In the World Global Survey, the latest survey, we are ranked 73rd in the world, which is obviously the worst ranking we've ever had. At times, we've been down at the 40-odd level. 73 suggests we are one of the most corrupt countries in the world. We're certainly not the most corrupt. What we've got to recognize is that in general, the world is a fairly corrupt place. So in order to become the most corrupt, you have to excel at corruption. We're not at that level yet, although obviously we've tried our best recently. How about the consumer? Could the consumer drive the growth in this economy? And the answer, unfortunately, is no. The reason is that consumers no longer have the income. If you look at income growth from the consumer, it's under pressure and has been under pressure in the last year. The reason for that pressure is fairly simple. We find that salaries are not growing as fast as they used to. We find that bonus payments have been scaled back. Tax rates have generally escalated. Errol mentioned the increase in or the lack of compensation for fiscal drag in the budget. That hurts. The increase in the VAT rate, that hurts. So the consumer's income has been systematically put under pressure. And without an increase in employment, it's not possible for the consumer to spend more money. At the moment, if you look at the chart I've got up on consumer spending versus consumer income, and you look right at the end of the chart, you'll see that at the moment, consumer spending is exceeding consumer income. In other words, households are living beyond their means. Now, we can do that for a short period of time. It's not recommended because obviously in order to do this, we've got to fund that increased spending by taking on additional debt. So the consumer is really continuing to shop in South Africa by becoming more indebted. Now, what debt is the consumer taking on? Particularly something called personal loans, or what we refer to as unsecured credit. So if you look at the growth in unsecured credit, you go to the beginning of this year, it was growing at roughly 2%, which is negligible growth. Fast forward a year and that growth rate is now approaching 12%, which tells us that the consumer is becoming more indebted because their income is falling, but they still want to keep shopping. It's a dangerous situation because obviously it can get out of hand and consumers can then get into financial distress. Out of interest, not all of the banks are growing their personal loans in the same way. I looked at the recent breakdown according to banks, and at the moment First National Bank is growing their personal loan book by 19% year on year, and they're leading this growth rate. And obviously that has to be something of a concern because if it ends in financial distress, then that 19% growth will seem badly judged, even though you're gaining market share. ABSA, not too far behind, they're growing at about 14%. So they're also gaining some market share in terms of personal loans. But if you look at Standard Bank, that growth rate is down at 4%. Which says that in effect, Standard Bank is losing market share in the personal loan space, but recognize that there are potential problems down the line as consumers become more financially distressed. So it's not necessarily a bad thing to lose a bit of market share if this ultimately ends unfavorably. What isn't growing at the moment, and I think it's very sad, is mortgages. So if you look at residential mortgages, they are growing at about 3% and have been growing at 3% for 10 years, which means that the housing market is stagnant, the building of housing is stagnant. And what it says, and it's a really not a good takeaway, and that it says banks are much more willing to finance personal loans rather than finance housing. And to me, that's not a good balance. I can understand it from the bank's perspective in terms of the profitability of various instruments, but it's not ideal from an economic mix. You would rather see the development of a housing market than necessarily funding people to go shopping. So as it stands, I don't think that consumers are in a position to really drive this economy. So you have to conclude, if consumers aren't in a position, the government has become highly indebted, state-owned enterprises are a little bit dysfunctional with a lot of debt. How do you grow South Africa? If you're the president and you want to lift the growth rate from 1% to 3%, what are your choices? And there's only one choice, and it's the same choice I've been mentioning, I think, for the last 5 years, because it is the only choice, and that is you've got to inspire business confidence. Unfortunately, business confidence continues to decline. The latest number is the first quarter of this year. Business confidence weakened further. And if you look at the business confidence since the president was elected more than a year ago, it's actually declined. The president, I think, has done some good speeches. The State of the Nation, I thought, was a good speech. The intention, I think, from the president and from government is correct. The problem is that nice speeches are not enough. When you look at what business is after, they want to know that action is being taken. So let me give you an example. Go back to the State of the Nation address earlier this year. I thought the speech by Cyril was good. It covered all the right bases. It said essentially the right thing. It was compelling. I thought it was uplifting. And if you look at the comments that followed that speech, they were generally positive. The next week, we switched off the lights in South Africa. So what matters more to business? A good speech that says the right thing, or the fact that we don't have electricity? And it turns out that business worries much more about electricity than they do about nice speeches. And the result of that is business confidence remains weak. So the task for Cyril is to move away from just simply doing nice speeches into what can I do practically, what can I implement in order to move this economy forward. If we can do that and lift business confidence, then we think business will start to invest more. As it turns out, business investment has been on a steady decline for the last 4 years. And right now, business investment or private sector investment is 11% of this economy. When the National Development Plan was put together by the government a while ago, including by Trevor Manuel, he highlighted that private sector investment had to be up ideally at 20% of GDP. At the moment, it's 11%. That on its own tells you that private sector is not investing nearly enough in this economy in order for the economy to be vibrant. That doesn't mean that private sector doesn't have the money. We know that the corporate community balance sheet's in good shape. Particularly corporate debt is fairly low by global standards. So all of the data on the corporate balance sheet tells us cash levels are good, corporate debt is low, corporates are reasonably well managed, they're conservative. All of those things still apply. Unfortunately, having a good balance sheet is not enough. What you need is a good balance sheet and a high level of confidence. So the missing ingredients in South Africa is business confidence. Now, has the president said anything about trying to improve confidence? And the answer unequivocally is yes. And he's put forward a measurement that he's willing to try and achieve over the next 3 years, and that is the ease of doing business. So let me quickly explain. The World Bank does a global survey on how easy is it to do business within 190 countries. They put out that survey once a year, and the latest survey shows that South Africa is ranked 82nd in the world. In other words, South Africa is the 82nd easiest place to do business, which is dreadful. A couple of years ago, we used to be down in the 30, ranked about 35 or so. We've slipped to 82nd, which means that in the last 5 years, we have made it way more difficult to do business in the country. That is not good for business and business confidence. What the president has said is that he set a target for the ease of doing business survey to be within the top 50 within the next 3 years. I think that is a good objective. I think it's an achievable objective, and it's something we'll monitor year by year to see the progress that we're making. So which particular areas of doing business is problematic in South Africa? And there are a couple of areas that stand out. The first, and I suppose the main problem, is the ease of starting a business. If you want to start a business in South Africa, we are regarded as the 134th easiest place in the world to start a business. That is shockingly bad. A few years ago, literally 4 years ago, we were ranked 61st in the world. 61st is still bad. So 134th is dreadful. What that says is that it's become incredibly difficult in South Africa to start a business. The other measures are also not particularly good. Our ability to get credit for business, our ability to do cross-border trade, to trade with other countries is difficult. Our ability to enforce contracts is difficult. The area we excel at the most is that we make it very easy for people to pay taxes. But I'm not convinced that's really what business is after when they look at the ease of doing business. So when you talk to business owners, particularly small and medium enterprises, they flag this as a major concern. And the president has given his undertaking that this is going to be within the top 50 within 3 years. Now, I just want to highlight a country that has been able to achieve the same goal within a short period of time, and that country is Rwanda. And many people are surprised by it. But if you look at Rwanda's ease of doing business in a global context, they are ranked 29th in the world right now. And that's on a global scale. And if you say to me, what has Rwanda done right? What they've done is they've introduced technology and made use of technology to simply make it easier to operate. So I'll give you an example. If you want to start a business in Rwanda, you don't have to physically go to a government department, collect forms, and then go back because you've got the wrong forms, then stand in a queue, then change queues because you're in the wrong queue, then find out your forms have been lost. You don't have that process. All you do in Rwanda is you go online and you fill in all of your information online, you submit the form, and you are registered to start a business. So they have purposely gone about finding ways to make it easier to do business. And it works wonders for business confidence and ultimately for investment. So from my perspective, where do we find ourselves? Right now, the growth rate is obviously weak. The consumer's under pressure. South Africa is facing electricity outages. Business confidence is tired and fairly unexcited. But I do think that South Africa is systematically more aware of the challenges ahead. We're much more aware of the problems when it comes to corruption. We're much more aware of the problems in the state-owned enterprises. The president has started to change the management of many of the SOEs. He's indicated that he will revise government departments after the election. We have started to put in place initiatives to encourage and uplifting business confidence, etc. I do think that in order for these to gain traction, we're going to have to move past the election on the 8th of May. The idea is that past the election, perhaps the president will be able to focus more fully on the tasks at hand, which includes revitalizing this economy. We think the Zondo Commission will have made more progress. We think that by the end of the year, there will be charges laid against key officials. We also think that the Eskom restructuring that was announced in the budget will have proceeded more by the end of the year. So what we're suggesting is that second half of this year, the economy will start to look better. Yes, the global environment is under pressure, but we think we can make headway off a low base. Clearly, that's going to require that the election itself goes smoothly and that the outcome doesn't result in a degree of uncertainty and ambiguity around policy. It does mean that Cyril's going to have to feel that he's more empowered than he is at the moment, and I think systematically he is gaining authority within the ANC. It also means that we've got to deal with the load shedding more effectively than we currently appear to be doing, and we've got to get the input from the various task teams and hopefully start to stabilize the situation. It also means that we ideally have to avoid any further credit rating downgrade. So if we look at the credit rating debate, it'll be a focus on Moody's on Friday. We're not sure exactly what time they'll announce that. It generally is after the close of business New York time, which puts the announcement at around midnight on Friday. Obviously, we'll follow it and analyze it when it happens. And what we're hoping is that Moody's will allow us more time to make these changes. We're still on an investment grade by Moody's. The credit rating outlook is stable. Obviously, the deterioration in the economy this year makes that view from Moody's a difficult decision. It's not as if they will make a decision to leave us alone lightly, because clearly South Africa's under pressure. But so far, they have been more encouraging of South Africa's developments, and I do expect that encouragement to continue. I don't think South Africa is going to go to below investment grade on Friday. If they do decide to revise it, it will be that they revise the outlook statement on South Africa from stable to negative, but at least leave the credit rating unchanged at an investment grade. So I think we'll get past that hurdle. The next hurdle is the election, and then the hard work starts on trying to implement some of these policy discussions that have been going on in the last couple of months. So I'm more optimistic about South Africa's second half than first half. And I'm also more encouraged by the valuation debate around South African assets. We get a lot of discussion around how to position portfolios under current circumstances. Obviously, being invested in equities has not been rewarding in the last couple of years. Being invested in income funds has been a much more sensible approach. But I would just be cautious about becoming even more conservative on your investments, because when you look at this from a valuation perspective, any uplift in South Africa's growth rate over the next 18 to 24 months would make the valuation argument fairly compelling. In other words, any uplift to South African earnings would suggest that South African equities do offer value. So our point of view is that, yes, in the short term, we would be more conservatively invested. That's been the right position. We'd be a bit more cautious. That's been correct. But we're also aware that if we start to get one or two things right in South Africa, and the second half of the year and into 2020, we do get some economic expansion, then I think there's going to be a lot of positive interest in South African risky assets, particularly South African equities. I think that's more or less all we're going to talk about at the moment. We've got already a couple of questions, and I just want to deal with two in particular that I'm aware of. The first question relates to, should people be changing their risk profile if the economic environment changes? And the answer is undoubtedly no. Having a risk profile is not dependent on the economic environment in which you find yourself. Your risk profile, or the client's risk profile, is dependent on their personal circumstance, their age, their family environment, what their objectives are in terms of paying for education or saving for retirement, etc. It's got nothing to do with the specific economic environment in which you find yourself, which means that if you're going to do risk profiling correctly, you've got to assess the person's personal circumstances and their personal goals, and then derive an investment strategy that will meet that goal over time. When it comes to changes in economic circumstances, the fund manager, that's his job to try and manage the portfolio as best as possible to take account of changing economic circumstances. If you at the same time change the risk profile, you are really going to be distorting the outcome, and particularly the long-term investment outcome for the client. Not a good strategy. Allow the fund manager to either become more conservative or more aggressive, depending on how he sees the economic environment, and focus on making sure that the risk profile is appropriate. If after 10 years, the circumstances for the client has changed and they've now got a family, they've got kids, or they've now retired, then yes, the risk profile will then change, which then says that we need a different mix of assets or a different plan for the investments that the client has got. But don't change the risk profile as the economy changes. Added to that, it's not a good idea to try and constantly time the markets in order to maximize the return. The problem with timing the markets is that invariably most participants will get the timing wrong and can find themselves doubling up on any particular loss or negative return. So my view is the risk profiles are there for good reason, the goal focus is there for good reason, and hopefully the fund manager changes the particular asset mix or asset classes appropriately to take account where necessary of changing economic conditions. The second question I have relates to listed property, and particularly Stanlib's listed property. And I can make some general comments about property in South Africa. What we've got to recognize is that longer term, listed property has been a brilliant investment, and it still remains over a long period of time one of the best investment outcomes that you could have achieved had you invested a number of years ago. More recently, though, the weakness in the South African economy has started to undermine the property sector. We see that in increased vacancies, increased revisions. By that I mean every time the client renegotiates the lease, you find that there's a downgrade of the lease amount, and obviously the property company and property earnings come under pressure. And you have to acknowledge that that remains the situation. The fundamentals for South African listed property remain challenging, whether that's in office space or whether that's in retail shopping centers or industrial space. There's generally an increase in vacancies, rentals are under pressure, and obviously income for many property companies are under pressure. So does that mean we should run away from property? Again, I'd be cautious. The negative performance is already in the markets, in the price. I don't think the valuations right now are that demanding. And remember, what we're looking for is for South Africa to systematically put in place changes that start to lift the growth rate. And if we start to get that right, then obviously the uptake into the property sector will follow with something of a lag. So I do think that this is not the right time to run away from listed property. I think you've already taken that pain. I do think, though, in order to see a solid return, you have to take a longer term view. And that view is probably right now a 5-year view on listed property, because I think it's going to take time for the economy to gain significant momentum and listed property companies to then show the benefit of that. So right now, yes, the fundamentals are challenging, but I do think that most of that is already in the price. So in terms of some of the other questions, we've got a question that relates to how can corporates like the bank solicit business to invest and grow instead of holding on to their cash. What I think we've got to recognize is that businesses in South Africa tend to be fairly conservative and conservatively managed. And over time, that's actually not necessarily a bad thing. It means that when difficult times occur, South African corporates have withstood those challenges quite well. And that remains the case now. If you think this economy is only growing at 1%, yet South African corporates, yeah, they've undertaken some retrenchment, some restructuring. But if I look at global environment, the fallout can be a lot worse, where you have mass retrenchments and business failures and business closures. I think the South African economy needs a boost in terms of confidence, and some of that has to come from government. There's no other choice. I do think that systematically that confidence level will build up from the government after the election. But at the same time, South Africa lacks what we call mavericks, business leaders who are willing to invest even though the environment is challenging. And perhaps business needs to reflect on that aspect, to take more risk, to go out and venture where others have been unwilling, to try things that others have shied away from. And perhaps then we need to create more of an environment where entrepreneurs, a true entrepreneur and a true business maverick can find an opportunity to flourish. We don't quite have that in the space at the moment. We've got a question on policy recommendations, and the question says, besides land, labor, and minerals, what would be your top 3 policy recommendations for the government to grow confidence and the economy in general? When you advise government right now, what you have to be aware of is that government's got to find a way to implement policy that is politically acceptable. That is not easy to do, but we feel there are a number of initiatives that could be put in place and that could lift confidence that we don't think are politically difficult. The most obvious would be what I've mentioned, the ease of doing business. Simply remove bureaucracy, remove regulation and a lot of the bad administration, and help business with whatever they need to accomplish. That would help to lift business confidence. We also think that the government can do quite a lot to encourage tourism. It's not a politically sensitive area. We've had some poor regulation introduced that has stifled tourism. If you look at South Africa's performance on a global tourist basis, we perform exceptionally poorly. I think South Africa can do a lot more to encourage foreign tourism into South Africa, and I think that on its own would go a long way to lifting confidence. I think that if we start to see prosecutions of key individuals involved in either state capture or outright corruption, that would help to suggest that government is serious about cleaning up government provision of services and administration. So hopefully the Zondo Commission starts to recommend actual prosecutions. I think that would help. The other area is obviously to try and encourage housing development. There's no doubt South Africa has a shortage of housing, and to find a way to unlock housing. Let me give you a basic example. If you look at housing development in South Africa, it at the moment comprises 1.8% of South Africa's GDP. So housing starts, building housing renovation is 1.8%. If you look at the global average, it sits at 5%. And in even many developed economies that don't really have a housing shortage, they would comfortably spend 3 or 4% of their economy on housing development. We are nowhere near that. So to me, housing would be key. Obviously, trying to promote small business and startup business by making it easier to do business, that would help as well. So I think there are a number of initiatives that government has already spoken about. They're not new, that could be put in place. They don't have to try and deal with trade unions. They don't have to deal with mining rights and mining regulation. Don't have to deal with land redistribution, etc., which remain problematic political issues. I think there are other initiatives the government could focus on as kind of quick wins to try and lift South Africa's growth more meaningfully. Just quickly looking for other questions. Question says, government continues to pay lip service to creating a balanced economic playing field to encourage the establishment of new economic outputs for self-employed South Africans. What should government do to actively encourage business growth for self-employed SMEs? I couldn't agree more with that. We don't have nearly enough focus on promoting small business in this country. If you listen to government talk, though, they do argue that they want small business. They even have a government department focused on small business development. But just the statistic I mentioned on how easy is it to start business suggests that government is not doing enough. We do think that with government setting a target of getting us into the top 50 in terms of the global ease of doing business, they're going to have to focus on how they make doing business for small business a lot easier. And it's certainly something we actively discuss with government. And that just means less regulation, less paperwork, looking hard at what rules we do have in place and whether we really need those. And I think there will be initiatives to challenge those during the course of this year. I don't know if there are any other questions. I don't have anything really at this stage.
Looks like that might be it. Okay. Well, that's it. Thanks, Kevin. No more questions for now. If you think up of any more questions later on, guys, you can email us, and then we will get back to you with the answer. If you'd like to carry on the conversation with the financial planner, please walk into any Standard Bank branch. There are financial planners in all our branches, and they can assist you. If you can't do that, you can simply SMS the word guide, GUIDE, guide to 31791, and a financial planner will be in contact with you. If you don't want to use the cell phone and you want to send an email instead, you can do that as well. You just SMS to SBFC call center at standardbank.co.za. SBFC call center at standardbank.co.za, and a financial planner will be in touch. Thank you so much for sitting in with us for this hour. We hope you got in as much as you could, and we'll see you for our next webinar, which will be next month. And then we'll send out invitations closer to the time. Thank you very much, ladies and gentlemen. Have a good afternoon further.